The stock market is going to crash. That is what everyone seems to be saying, as we've seen a crazy run in the green over the last 6 months to a year plus. So what we're going to look at today are some funds that are designed to hold up better in a bad market. We're going to explore the use cases with these ETFs and see if it's even worth bothering having some hedge in the stock market. So I hope you guys are ready. These are dividend-focused funds, and I'm really excited to showcase them for the first time on this channel. If you guys are interested in dividends, in ETFs, you are in the right spot. Don't forget to like the video and to subscribe so you don't miss out on all the free content. Let's roll that intro. We're going to take a look at some NEOS ETFs and not the typical ones. These are still income-focused ETFs, but unlike SPYI and QQQI, they are hedged for some protection using some protective puts. Now, if you don't know, you can explore all of this on their website, and the website looks phenomenal, by the way. So we're going to start with SPYH. SPYH. Don't call it that. It's a monthly payer, and wait, pause, before you just say, no way, the yield is too low at 7.88%. Hear me out. These things are designed for one specific market, and we're going to discuss that in the video, as well as, of course, the use case and if I would ever hold these specifically. Expense ratio is similar, 0.68%, a little bit high for my liking, but SPYH, let's talk about it. So it has the same tax benefits as SPYI, and we will do a comparison between QQQI and QQQH and SPYI and SPYH in just a moment. But it has that same tax benefit with the 1256 contracts, which is important right off the bat. They're more tax beneficial if you keep them outside of like a Roth IRA. I got a comment on the last video talking about that, so I do want to showcase these ones again. I don't know if it's all NEOS ETFs, but most of them do use that efficient form of paying the dividends or distributions. Now, it offers a measure of downside protection via a constant, fully financed market hedge that seeks to reduce downside risk. The fund may offer flexibility across markets, a systematic approach that may aid in capturing gains and minimize losses. So let's talk about this fund versus SPYI. How do they correlate? Well, SPYI is going to do better on the growth side and on the income side. And that's just the way it is. So if you're long on a really green market and you think we'll never have a crazy pullback, then SPYI is the go-to. What SPYH does is it holds up better in bad markets. And I don't know what the market is going to do. I will be the first to say, I am not going to predict it. I'm not even going to try, but I want to have everything available to my portfolio if I do see a pullback in the market. So SPYH, the way it utilizes these protective puts, basically means if we saw a steep crash in the market, it would hold up better for your NAV. Of course, you're still going to get a lower yield, but it would hold up better for your NAV. And so for those that are really risk averse, it's a way to bet on the market's volatility in a way. You're still getting that yield, but you're not betting on the market only going up indefinitely. And so like I said, I'm going to showcase a side-by-side comparison with these. I actually geeked out and ran some crazy numbers on it. So I'm excited to showcase how these two funds compare. But first, let's check out QQQH. Everything with QQQH is the same with SPYH. Only difference is this is on the NASDAQ, not the S&P 500. And so you're going to get a better yield, a 9.1% yield or distribution rate because they are ETFs. But there is one important factor with QQQH that I think is really funny. I don't know if you guys have been trading ETFs for a while. I have. I've been trading these for 2 years. So 2 years plus. And before that, I was investing in dividend stocks primarily. But there used to be a fund called NUSI, ticker NUSI. And it was actually taken over by NEOS. So QQQH began as the nationwide NASDAQ 100 Risk Managed Income ETF, the predecessor fund to QQQH, an ETF that operated since December 19 of 2019 under the ticker NUSI. As of close of business on November 8 of 2024, the NEOS NASDAQ 100 Hedge Equity Income ETF acquired the predecessor's funds, assets, and liabilities and assumed its performance, financial, and other historical information. So NUSI converted to QQQH. And now I think this is very interesting because I watched NUSI for quite a while. I was checking it out. It was back when ETFs were still interesting and very new at that point. Again, it's 2019. So it's been, man, I just realized how long ago that was. That is absolutely crazy. But I watched this one because I was like, well, markets are all over the place. Let's see how it holds up. And it didn't hold up as well. I watched it after 2019, I will say, but it was kind of capped on the upside, of course, because the market was super hot after the pandemic drop. And I was never interested in it as a fund because it seemed to underperform a lot of the other funds. But now it has been overtaken by Neos. They've switched up the strategy a little bit. I can't even remember Nusi's original strategy, but we have seen some pretty interesting performance from QQQH. So we've talked about the history of these funds, both of them. We talked about the differences between these funds and the normal income funds by Neos. Next, we're going to throw up our Seeking Alpha comparison tool and check out the exact differences. And then we're going to compare direct numbers to showcase how we could utilize these and what markets are better for which fund. And then, of course, I'm going to actually show you the use case for these and if I'm going to buy them. Starting with the NASDAQ comparison, so we have QQQI and QQQH. Same expense ratio, AUM is wildly different as we see 5 billion in QQQI and under 350 million in QQQH, which is expected in a green market like we've been in. Now, scrolling down, we can see on price return, both have held up really well over the last year. There's not much of a difference whatsoever, to be honest. They're barely off by 0.03%. But when we go to total return, we see QQQI outperform. And that, again, is how it's supposed to be because the market has been good. This is not the style of market where you would buy a hedged fund, a protected fund, i.e. QQQH, because the market has been absolutely rocketing. Now, there was one drop that we saw, a significant drop from February 19, and it ended April 8th. And so I will showcase the numbers on that drop, but I wanted to show you guys also with these funds, they have been trading for a bit longer, although QQQI, of course, is newer than QQQH because it was that other fund before. But still very interesting. It's hard to compare them in this sense because they had different start dates, but really impressive long-term how QQQH has still gone up almost 80% with dividends dividends included over the last 3-year period. So what we're going to do now, we're going to look at our spreadsheet, and I'm going to show you guys the main portion of, I guess I should say, the meat of this video. When would we hold QQQH? How does it hold up in this drop? And this was not just a small little drop. It was a pretty steep drop. So let's check it out. Okay, I know my spreadsheet is not the prettiest in the world, but look at this. We have our before drop and our after drop. So for QQQI, on the year, up until February 19th, something like that, it was up 12%. After the drop, it went all the way down to being in the red by 10.4%. The same number for QQQH, same time span, it was up 7.7%. It was up less, but it dropped less. It went from 7.7 to 8.65% in the red. So our results, we saw a 22.4% drop for QQQI and a 16.5% drop for QQQH, a 26% difference, meaning QQQH held up 27% better than QQQI. And that is what these funds are made to do. So I'm also going to showcase that on the chart, and we'll look at it with both SPYI and SPYH, just so you guys can get the full understanding of the selected time frame. For SPYI, we have 5.5 billion in AUM, or assets under management. SPYH, only 10 million, a little under even. But again, similar with the NASDAQ funds, it's what we expect in this market. Now, looking at price return, it's very interesting. SPYH only launched in April of 2025. So we can't do the full back test like we did with the QQQH, because there wasn't a fund that was adopted into the Neos group like NUSI was, which is very interesting. So what they did was Neos said, oh, we have this fund on the NASDAQ, let's put one on the S&P as well, and boom, they put this fund out, which I think is a great idea. Now, we can't fully compare, but I do want to showcase with price return, we can see that I took the start date for this one was April 3rd, because it was the first day that we had both funds available. And so that will be really, really important in our tracking spreadsheet as well. And since then, SPYH has done well. It's definitely not bad. It might even be outperforming SPYI with the dividends included just because of the time that it launched. SPYI was very green and then took a dip, and then we launched SPYH, and so it is a better performer according to the Seeking Alpha tool, which if you're interested in using Seeking Alpha Premium, use my link down below. Check it out. You can use this tool whether you have premium or not, but I thought people might want to check it out because Seeking Alpha has some really cool and really good features as well in their premium and their alpha picks, which I will be doing some content on. If you're a fan of the alpha picks, I'll be doing some content on those in my backup channel or my smaller channel. my growth-focused channel. So we still have two very important questions to answer. We're going to look at the data, but when would we utilize these ETFs, and will I personally be buying them? So I'll start first with our data. So SPYI versus SPYH. Again, the difference, same sort of results. We back tested it, the before drop and after drop, and we saw that SPYI fell more than SPYH, which was expected. And then we also saw that this one had a higher percent difference, meaning that SPYH held up even better in comparison to SPYI than QQQH did to QQQI, a 40% difference, which is very, very important. So let's absolutely talk about this. What is the use case for these ETFs? Well, if we all knew that the market was going to drop, it would be phenomenal to be able to swap and to go all into these put protected ETFs, but we don't know that. So what it really comes down to is if you believe that we could see a pullback, or you want to hedge maybe 30%, maybe 20% of your positions in QQQI and SPYI because a pullback is near, that is one option. That's what they're designed to do. Another thing that we may see, and I'm not hoping for this by any means, trust me, we could see a crazy pullback in the market. And when these would really excel is if we saw a steady decline in the market, not necessarily one insane drop. That would still hurt these really badly. But if we saw a steady decline over, let's say, 6 months to a year of a red market, who knows, whether it be a world conflict, another pandemic, fingers crossed, please no, please no. That could be an instance in where these ETFs shine. But you can't predict those things, unfortunately. If we could, again, we'd all be millionaires. So when it comes to SPYH and QQQH, I am not going to be buying them. And there's one really important factor with that. The last thing we haven't looked at on this page. Since the drop, so since I was back testing this, we have seen QQQI go up 37.53% from that low of 10.4% to only 27.43% in return from QQQH. And so that's based off both of their point when they were at the end of the drop to the current price. I did a drip calculator with dividends reinvested. And so we see it outperform by 10%. And same thing with SPYI and SPYH. We actually see, this is not a percentage, we see well, it is a percentage. We see SPYH going up 26% to SPYI's 29.72%. And what does this mean? If you had a rocky market, and here's what I'm planning on doing. If we had a rocky market where we saw things slowly decline over a long period of time, I would be more invested into QQQH and SPYH. When they don't really excel, in my opinion, this is my opinion only, not financial advice, where they don't truly excel is when you have a market that has crazy dips and then recovers. So here's my plan. If we see another dip like we did early on this year in February to April, what I'll do is I hold cash and I will simply buy QQQI and SPYI at a lower price, lowering my dollar cost average, which is amazing, but also catching this potential run back up that we've seen. And this is why I know some people don't like protective puts because they're a little bit expensive and you miss out on a lot of yield with that being a factor, but they do have a place. It just depends on the market and what you're looking for. So to recap this entire video, if you think our stock market is going to drop, if you think the economy is going to drop, if we're going to go into a recession, then QQQH and SPYH could be a good option as a hedge. How much you put in there, that's up to you. If you think that, again, is up to you. If you think we could see a rocky market, but an overall upward trending market for the next year, 10 years, then QQQI and SPYI are going to outperform in both growth and income. But that is, of course, the factor of the market. There also is an amazing thing with QQQH and SPYH. In a dropping market, you can still get some pretty good yields, 8 and 9% on these income ETFs, even if we're in a red market. Whereas QQQI and SPYI, your percentages are going to it's going to get tough because the price average is going to be dropping consistently. So again, if you're interested, if you think that QQQH and SPYH are going to outperform, you believe the market will go down over time. And inverse of that is QQQI and SPYI, with the market going up, the prices going up and getting more of those dividends. So I hope you guys enjoyed. If you want to see me do more styles like this, more videos like this on some protective ETFs that will survive the bear market and could actually flourish in it, let me know in the comments. And I hope you enjoyed this different style of video. As always, don't forget, if you did find it informative or at least entertaining, to like and subscribe so you don't miss out on all the future content. And if you like this video, check these out on your screen right now. I know you're going to enjoy them just as much. Thank you guys so much, and don't forget to spread some love today.